Oh man, great article I saw reading during my research on preferred stocks. I came across this one from Forbes. Martin Fridson, not familiar with him, from Intelligent Investing. Not familiar with them. That doesn't mean anything. It's a good article, but don't judge preferreds by 2008, 2009 performance. Remember when I gave you the whiteboard, what happened in prefers, financial prefers in 2000, or this was VFF, excuse me, not even financial, is the ETF, the iShares preferred stock. I think it's just the iShares preferred stock, essentially index. And it got hammered. It was down 54% from October 1st to March 9th of 2009. So from October 1st, 2007 to March 9th of 2009. 54%. It was down more than the total stock market index. And that was burning me once burned, right? And so I said, I'm not going to go twice shy. Isn't that some kind of like glam rock, once burned, twice shy? So, oh, glam rock, the worst. Anyway, but I came across it. I thought it was pretty interesting because I still like prefers. I think prefers have a nice place in any portfolio if you're looking for income because, I don't like bonds. And I figure you might as well, to get more yield, you might as well take a little bit more risk. And prefers certainly have it. 2008 and 9 was not was the exception, was the outlier for sure. As is 1982 with bonds. So bonds have a significant outlier as well that I think a lot of people get seduced and thinking, oh, bonds have averaged since the last 30 years, better than stocks. Oh, those days are long gone, never to return. I'm just telling you, it's never to return. There's no way you're going to get those kind of returns in bonds. It ain't happening. But at least prefers have an outlier similar to bonds, but give you about twice the yield roughly, with more risk, but certainly not twice the risk. So let's dive into this. Martin Fridson says, don't judge prefers by 2008, 2009 performance. And again, this is Dateline, June 28, 2018. Preferred securities took a beating in the Great Recession. Once bitten, twice shy. That's it. Isn't that a song? Income investors may begin to, that's exactly what happened to me. Once bitten, how do I close this guy out right there? All right. Don't need to see John Mackey. Don't care. All right. Once bitten, twice shy income investors may begin to shun the asset class once they conclude that the next economic contraction is imminent. I just did a video talking about the idea that increasing interest rates are mean we're going to go into a recession. Two reasons I don't like that. One, because if interest rates are increasing, that means people are dropping their bonds. That doesn't make sense. The demand for bonds has gone off the cliff. Demand for bonds fall off a cliff. What happens to the yields? They go up. So if the demand for bonds goes up into the sky, what happens to the yields? They go down. So what would be more inclined to indicate a recession? Increasing demand for bonds or decreasing demand for bonds? Increasing demand for bonds, lower yields, and that's what we're kind of seeing. We're seeing a flat yield curve not yield curve, but flat yields for demand, basically as far as the eye can see. Years going back now, and I just did a video that said 30-year treasuries at 3. Fast forward or go back in the past of 2013, the 30-year treasury was at 3. Exactly. So there's been no change, none. So we can't say increasing rates. And then the Fed have raised rates 5 times last year, and there is no increase in interest rates at all. In fact, the 10-year is actually a little bit lower than it was the start of this year. So it's silly. I don't get that. Secondly, if you were thought a recession was imminent and people are fleeing risk assets to safe assets, what's called a flight to quality. Again, you see interest rates going down. They somewhat have a little bit, not much, but you see a vast increase in demand, which will lead to interest rate decline. But you'd also see a sale of stocks, and you're not seeing that at all. This year has been a pretty good year thus far in 2019. So I don't buy it, but hey, whatever. There's always a recession looming around the corner. There's always a bear market. Just deal with it. It always happens. It has nothing to do with anything other than the business cycle. And as I said yesterday just a few minutes ago in the video, socialism doesn't solve business cycles. Socialism basically makes the business cycle permanent in terms of recession. That's what socialism does. There's a permanent business cycle of a recession. All right, capitalism, yes, we're going to have recessions, bear market, but by and large, we have a whole lot more growth than we do recession. All right, so in the table below, the shaded segment further to the right, it confirms that 2008 to June of 2009, the total return of the fixed rate preferred securities index was about 23.2. Note that this index only includes investment-grade issues. Investors would have been far better off in the safe haven of Treasury index, which is up about 9. Now, it's even worse than that because don't forget, from October 2007 to March 9th of 2009, it wasn't 23.2. It was 54% for the VFF. Even cash represented by the Treasury bill outperformed prefers with 2.16% total return. That makes sense. The only note that T-bills pay no coupon, so price change equals total return. The only consolation was that the true to their senior status vis-a-vis common equity prefers delivered a high total return than common stocks, the S&P 500, during the severe bear market that accompanied the Great Recession. No, that did not. It prefers, at least according to the VFF, which mimics this, the Bank of America index they're using, was down 54%. The total stock market was down 50%. Now, that's price to price point. I'm just using price to price. When you factor in the yield you got, it was less than 54%, but it's still significantly higher than the S&P 500. Without question. All right. But here, let's go look. Okay, so here's 1990 to 1991 recession. August 1990 to March of 91. This is what got Bill Clinton elected, by the way, because we typically don't feel the recession, at least in terms of how the media leads us, until about a year later. And that's exactly what happened in 1992 that got Bush to lose office. Actually, Ross Perot jumped in there, but still, Clinton was hanging, and the media was going with it. We're in a great recession, the worst recession since the Great Depression. Wasn't true, but don't expect the media to play fairly. All right, so anyway, asset class, price, total return. So the preferreds in 1990, August recession, 1990 to March 91, they averaged 10.4% in total return for that time, where the stocks averaged 7.93, Treasury 7.12, and T-bills 5.12. So in a recession of 1990 to 1991, prefers did better, significantly better than everything else. The prior 12 months, the prefers were up 14%, where stocks were up 14.9, Treasuries 13.48, and T-bills 8.88. I just need to reiterate, you're never going to get this again in Treasuries. I'm just telling you, don't, because you got to look at what the Treasury yields were back then, and they were in the double digits. You're not going to get this again in Treasury. So please don't say Treasuries will give us stock-like return with bond-like risk. It's not. I just cannot stress that enough. All right, so let's go over here. Where's the table? Oh, there we go. Okay, cool. All right, sweet. Here's the recession of April to November 2001. Prefers are up 6%, stocks are down 1%. Here's a recession. The 12 months before that recession, prefers up 23.5%, stocks are down 21%. All right, bonds are up 17 and 18%. So again, prefers in the recession did better than everything else. Prefers the 12 months previous to the recession did better than everything else either. So not only did it have staying power in the recession, it did during the previous to the recession as well. Prefers, other than stocks, prefers did better than everything except for stocks in the previous 12 months before the recession in 1990. And even that was spit distance. Let's keep going. So here's a recession of January. Yeah, this is where we got hammered. Right here. January, I don't know why they do January 7th to June 9th. I don't get that. But anyway, total return was down 31%. Stocks are down 31%. Treasury bonds are up 18%, and Treasury bills were up 7%. So there's so of the three, what you got? One, prior 12 months. There you go. Plus recession. Okay, I got it. Prior 12 months plus recession. So prefers got hammered, stocks got hammered, Treasury did great, Treasury bills did great. The prior 12 months plus recession in the 2001 recession, prefers did great, stocks got hammered, Treasury did great, Treasury bills did great. The recession of the prior 12 months plus the recession, prefers did great, stocks did great, Treasury did great, and Treasury bills did great too. So there you go. Recency bias is likely distorting investors' perception of the recession and risk and prefers. The shaded sections of the table show that previous two recessions preferred delivered higher total returns than both stocks and Treasuries, not to mention T-bills. In both periods, moreover, the preferred index registered a price gain in face of the recession. So not only did they make money on their yield, they made money on the price-to-price point. The unshaded portions of the table address the valid point that financial markets are forward-looking. Our analysis should therefore also assess performance on the lead-ups to the recessions. Accordingly, the table's unshaded sections add each measurement to the prior 12 years, 12 months prior to the recession. So we talked about that. So basically, here's unshaded is a prior 12 months plus the recession, and preferred to fine. My conclusion are similar to those for the official recession dates. Prefers posted higher total returns than the other three asset classes in the 2001 recession and the 1990 recession. They beat T-bills, they beat bonds, and they narrowly lost the S&P 500 in one time they beat it. Similarly, in the unusual Great Recession, the S&P beat prefers. It's just because prefers are so heavy in financials. That's why. I mean, no other way around that. So the three recessions for which the returns on the preferred index are available represent a very small sample size. One could argue that the contrast of prefers relative performance between the Great Recession and the two other recessions represents nothing more than a random variation. I think otherwise, and not only because the 2008 episode was the most severe economic downturn since the 1930s, but for the present discussion, what most distinguished the Great Recession from the other recessions is that coincided with a near-death experience of the banking system, the global financial crisis. For the benefit of those who do not remember, here are some events of 2008 and 2009 that had no precedence like they did in 1991 or 2001. Lehman Brothers filed for bankruptcies, and Bear Stearns and Merrill Lynch were saved through shotgun marriages. All had preferred stocks in there. Lehman, Bear Stearns, and Merrill Lynch. U.S. Treasury had a backstop. Citigroup and Bank of America all had preferred stocks in there, big time, because preferreds are the biggest proponents or constituents of the preferred index are financials. The FDIC guaranteed the debt of all FDIC-insured institutions, not just the amount in the savings and checking accounts, all debt. And the SEC can temporarily ban short selling of all financial stocks. With 70% of its value concentrated in the financial sector at the beginning of the Great Recession, the preferred index was bound to be hit especially hard by the financial crisis. Another reason it needed to be diversified. I did not heed that, and I got hammered myself. Now banks are in a better financial condition than circa 2007, thanks to the regulatory reforms instituted by the wake of the GFC. Why do we sit there and think the government knows what they're doing? The government caused it to begin with. Thanks to the regulatory environment for the CFPB, the Consumer Financial Protection Board. Where banks are in better shape. The same people who regulate us now are the ones who regulate us. So the banks had to give these insane loans. We are therefore unlikely to see the banking system life support during the next recession. I'm not holding my breath for that at all. Bottom line, income investors who extrapolate solely from the most recent highly atypical recession will probably enter the next recession with less than optimal exposure to it prefers. And I agree with that. And if you're in the Gwinnett, you can go to Gwinnett Gladiators hockey game, which are fun. Anyway, so that's the interesting article there. I'm a big fan of prefers. I think they have a place. I haven't talked much about them because I simply forgot, but I like them, and I think that something you should consider for sure. You're going to look at 2007 and 8 and 9 and say, but I'm just telling you, I think that is an outlier. It absolutely can happen again without question. But if you hang in there, as long as it prefers paid dividends, you will get paid. That's a fact. And as long as they come back in terms of paying dividends on a regular basis, you're probably going to see some price accumulation as well. But it doesn't matter. As long as you get the dividends, that's why you buy the prefers. It's for the dividends. And remember, they're taxed much more favorably than bond interest rate as well. Bond interest rates are taxed as ordinary income. Preferreds are taxed as qualified dividends by and large. So if you're buying a preferred, you're not buying it for appreciation. You're buying it for the income yield. As long as they pay their dividend, even if it's 1%, 1 penny, you will get your income yield. And that's a big deal. Significantly higher than bonds and significantly much more tax favorable as well. All right, don't forget to subscribe, smash the like button, and we'll see you next time.